The most recent financial statements for Hopkinton Tours Inc. follow sales for 2023 are projected to grow by 20%. Interest expense will remain constant. The tax rate and the dividend payout rate will remain constant. Costs, other expenses, current assets, and accounts payable will increase spontaneously with sales. If the firm is operating at full capacity and no new debt or equity is issued, what is the external financing need to support the 20% growth rate in sales? So when it's operating at capacity, that means that they need more assets in order to grow. And the external financing need, or EFN, can be found on your formula sheet, although you will have to know what these variables are. So let's go through it. So we have our EFN equals our increase in total assets minus our addition to retained earnings. So AG minus PSR times 1 plus G. Whereas S equals current sales, P equals net profit margin, R equals retention ratio, G equals sales growth rate, A equals assets that must grow with sales. Because not all assets have to grow with sales. And then we are going to less from A, spontaneous liabilities that grow with sales. So let's go through here and see what we can attach to this. So our current sales are 929,000. Our profit margin will be our net income divided by our net income divided by our sales, which comes to 0.121044. Our retention ratio is going to be say, sorry. Tax rate and dividend payout rate will also remain constant. So addition to retained earnings. So here we can determine, so if we add these together, it's approximately 110. Let me just do the math on my calculator. So 33,735 plus 78,715 And then 33735 divided by second answer. We get a retention rate. Dividend is, we have a 30% payout rate, and we have a 70% retention rate. So 0.7. Now our growth rate has been set at 20%. Okay, so now that we've got that, we've got to determine our assets that scale with sales. So which assets scale with sales? We've got cash, accounts receivable, and inventory. They will scale with sales. Our fixed plant and equipment will scale with sales. And then the spontaneous liability will be accounts payable will scale with sales. Notes payable won't, because that's just a long-term debt that you just are paying regularly. So what does that mean? Our current assets plus our fixed assets minus our accounts payable equals 152,900 plus 413,000 minus 68,000 equals 497,000. Okay, we can enter this into our formula now. So again, EFN equals 497,000 times 0.2 minus 0.121044 times 929,000 times 0.7 times 1 plus 0.20. And we can work that out. $497,000 times 0.2, 99,400 minus 0.7 times 929,000 times 0.121044 equals $78,714.91 times 1.2, which equals 78714.91 times 1.2. $99,400 minus $94,457.93. And we get $4,942.07 as our external financing needed. Now, what if we had only 80% capacity? So if the firm was operating at 80% capacity in 2023, well, we would need to see what our capacity is at. So we can do that by taking our sales, divide it by our 80% capacity. Our sales being 929,000 divided by 0.8. So our at capacity amount is 1,161,250. Now, if we were to grow next year's sales by 20%, do we have the capacity to support it? 1,114,800. Yes, we do. So this is smaller than this. So we don't need to add any new assets. Our current assets can support the amount. That's for our fix. So our assets, our current assets and our current payable will scale. So we'll have to do this formula one time. We're going to use the second formula here to do it one more time. And what we get is external financing needs equals minus P S R plus A minus P to the power of S R times G. So now we don't need to include our fixed assets in this asset, so that will change. What will change here with our formula is that this will just simply be 152,900 minus 6,800. So 80%, we're just going to call this 80% A is equal to 84,900 because we don't need to upgrade our fixed assets. So we can go ahead and put these numbers back in. Equals minus 0.121044 to sales of 929,000 times our retention rate of 0.7 plus our assets of 84,900 minus 0.12104 for 929,000 times our retention rate times our growth of 0.20. That's right, this is a negative number, so we have the negative here. So we end up with negative $77,477.89. So we will have no external financing needs. In fact, we'll have a surplus from our internal funds of $77,478.